I want to walk you through something I found while reviewing publicly released court and government documents related to Jeffrey Epstein and associated financial records. What I'm about to discuss is based on documents made public. This is not speculation, nor a conspiracy claim. It's an examination of financial communications and market history, raising questions about how sophisticated investors think about commodities, specifically silver. In late 2025, legislation required the release of previously sealed, unclassified records connected to Epstein and Ghislaine Maxwell. Since early 2026, millions of pages became publicly accessible, most attention focused on political and social figures mentioned in the files. My focus, however, has been on the financial records, emails, portfolio statements, and investment-related correspondence. While reviewing materials, I found a 2011 email discussing the silver market. It was sent by a financial professional to an email associated with Jeffrey Epstein. The subject referenced power of attorney and silver, suggesting account management and investment strategy, not casual commentary. In the email, the sender explained he was transitioning from a Swiss private bank needing updated authorization to manage accounts. Attached was research on the silver market. The sender believed a significant price squeeze could occur if futures contracts resulted in physical delivery. To understand why that matters, recall 2011. Silver rallied from $17 to $50 per ounce, then fell quickly after exchanges raised margin requirements. Analysts attributed the drop to leveraged speculation being forced out, rather than a dramatic change in long-term fundamentals. The 2011 email suggests the writer believed margin hikes primarily eliminated highly leveraged participants, but didn't fundamentally resolve supply-demand pressures. He projected higher long-term price targets and discussed the gold-to-silver ratio potentially narrowing over time. At the time, those projections were well above prevailing market sentiment. Fast forward to 2026, and silver has experienced renewed volatility. There have been notable movements in futures markets, changes in margin requirements, fluctuations in warehouse inventories, and shifts in global supply chains. Industrial demand, particularly from solar technology, electronics, and other high-growth sectors, has also increased compared to 2011. Alongside the 2011 email, I reviewed a J.P. Morgan portfolio statement associated with Ghislaine Maxwell from late 2010. The statement shows purchases of shares in a publicly traded silver mining company. Investing in mining equities during commodity volatility is not unusual. Many investors use mining stocks as leveraged exposure to underlying metal prices. The timing, however, aligns closely with the silver-focused research. It's important to be careful here. The existence of an email discussing silver and a separate portfolio statement showing mining stock purchases does not, by itself, prove coordination or misconduct. Large financial institutions and wealthy investors routinely analyze commodities, explore supply-demand dynamics, and position accordingly. Correlation does not establish intent. Separately, it is a matter of public record that J.P. Morgan paid significant fines in 2020 related to spoofing practices in precious metals markets. Spoofing involves placing orders without intent to execute them in order to influence short-term price perception. Multiple traders were prosecuted. That legal history is documented in court filings and regulatory settlements. However, it is essential not to conflate unrelated events. The presence of enforcement actions in one context does not automatically link to unrelated portfolio activity. Any discussion of connections must remain grounded in documented facts rather than inference. What stands out to me most is not the individuals involved, but the investment framework described in the 2011 research. Physical delivery versus paper settlement in futures markets, margin requirements as a mechanism that affects leveraged participants, supply deficits, and industrial demand as long-term drivers, the gold-to-silver ratio as a valuation metric. Those are legitimate analytical tools used across commodity markets. Since 2011, silver's industrial importance has grown. Governments have classified certain minerals as strategically important. Supply chain security has become a geopolitical priority. Vault inventories, lease rates, and backwardation are closely monitored indicators. These are measurable data points that investors analyze today. The broader takeaway is this: sophisticated investors have been studying the mechanics of the silver market for decades. Physical delivery, futures positioning, leverage dynamics, and supply constraints are not new ideas. They are recurring themes in commodity analysis. If you're interested in silver as an investment, the responsible approach is to focus on verifiable data: global mine production and recycling supply, industrial demand trends, exchange warehouse inventories, futures open interest and delivery volumes, government policy changes affecting trade or critical minerals, corporate earnings and balance sheets of mining companies. It's also important to understand risk. Commodity markets are volatile. Margin changes can trigger rapid price moves. Industrial demand can fluctuate with economic cycles. Mining equities carry operational and geopolitical risks. For transparency, I personally hold positions in silver and mining stocks. That means I have exposure to the market and a bias toward its long-term potential. This is not financial advice. Everyone should conduct independent research and consider their own risk tolerance. The documents I reviewed are publicly accessible. If you want to examine them yourself, you can search official public records and court archives. Always verify primary sources rather than relying on commentary, including mine. At the end of the day, the most interesting insight here isn't about personalities, it's about how high-level financial professionals think. They study structure, they analyze incentives, they examine supply chains. They understand that leverage, liquidity, and physical constraints shape markets over time. Silver has always been cyclical. It has experienced dramatic rallies and sharp declines before. Whether the future holds another significant move will depend on fundamentals, macroeconomic conditions, industrial growth, and investor behavior, not on any single email from 2011. The key question for any investor isn't what someone else may have believed years ago. It's whether today's data supports your thesis, and whether you understand the risks involved. Do your own research, stay grounded in verified information, and approach markets with discipline, not emotion. I'll see you in the next one. Before we wrap this up, I want to go one level deeper, not into speculation, but into structure. Markets move for reasons, not always the reasons that trend on social media, and not always the reasons that make headlines. They move because of liquidity, leverage, incentives, and constraints. When you study silver historically, you see repeating patterns. In 1980, leverage and concentrated positions created extreme volatility in the silver market. In 2011, margin increases flushed out leveraged traders during a parabolic run. In 2021, retail enthusiasm pushed prices higher briefly, but exposure was through financial instruments rather than large-scale physical delivery. Now in 2026, we see a market shaped by industrial demand, supply constraints, and strategic stockpiling, not short-term speculation alone. That evolution matters. The difference between a short-term spike and a structural repricing is who the dominant buyers are. Leveraged traders react to margin calls. ETFs react to inflows and outflows. Industrial consumers react to necessity. Governments react to strategic priorities. Very different motivations. When analysts talk about physical delivery, backwardation, or tightening inventories, they're not using dramatic language. They're describing mechanics. Futures contracts can be rolled forward or settled financially. But if a growing percentage results in physical delivery requests, warehouse inventories matter. If industrial demand continues rising, while mine supply grows slowly, deficits accumulate, pressure builds. But pressure doesn't equal inevitability. Silver is historically volatile. It can move 20% in weeks. It can retrace just as fast. It can stay undervalued longer than most investors expect. Timing is always the hardest part. Risk management matters more. If you believe in a long-term thesis, position sizing matters. Diversification matters. Liquidity matters. Emotional discipline matters. No asset should represent an all-or-nothing bet. Another important reality, large institutions and governments hedge. They don't just buy and hope. They structure exposure. They use derivatives, long-term contracts, diversified portfolios. Retail investors often underestimate that difference. So when you analyze any commodity, ask yourself, is demand cyclical or structural? Is supply elastic or constrained? Who are the marginal buyers? What would invalidate the thesis? That last question is the one most people skip. If mine production accelerates unexpectedly, that's a risk. If industrial demand slows, that's a risk. If substitution technology reduces silver usage or currency conditions shift capital elsewhere, those are real risks. It's easy to build a bullish narrative. It's harder and more responsible to stress test it. The documents we discussed show serious investors analyzing silver mechanics over a decade ago. That tells us the metal has long been viewed as strategically interesting. But analysis alone doesn't guarantee outcome. Markets require alignment of timing, liquidity, and macro conditions. If you're watching this series, the goal isn't to convince you of a predetermined conclusion. It's to equip you with frameworks, understand futures structure, understand margin dynamics, understand supply deficits, understand industrial demand trends, understand geopolitical influences. On critical minerals, once you understand structure, headlines become less emotional, price swings become less shocking, volatility becomes something to navigate instead of fear. And most importantly, never outsource your thinking. Verify data, read primary sources, cross-check numbers. Be skeptical of both hype and fear. Markets reward preparation, not panic. If you've made it this far, you're not just watching for entertainment, you're trying to understand mechanics. That already puts you ahead of most participants. Stay disciplined, stay data-driven, and I'll see you in the next one. Let's zoom out beyond silver itself. Every major commodity cycle in history has followed a similar arc. First, the asset is ignored, then it becomes controversial, then it becomes crowded, and finally, it becomes institutionalized. In the early phase, only specialists pay attention. Geologists, industry insiders, niche analysts. Prices are low. Volatility is minimal. Media coverage is non-existent. In the second phase, early data starts to shift. Supply tightens, demand rises, inventories fall. A few informed investors begin positioning quietly. The asset still isn't mainstream, but it's no longer invisible. In the third phase, narrative takes over. Price momentum attracts attention. Retail interest increases. Media headlines multiply. Volatility spikes. Leverage builds. This is where dramatic rallies happen. The final phase is different. The asset becomes part of long-term strategic planning. Governments classify it as critical. Corporations secure multi-year supply contracts. Institutions allocate capital structurally rather than speculatively. The conversation shifts from is this a trade to is this a necessity? Understanding which phase you're in is crucial, more important than predicting a specific price target. Right now, silver sits at the intersection of industrial growth, energy transition, electronics expansion, and geopolitical resource security. That doesn't guarantee explosive price action tomorrow, but it means the discussion is broader than short-term chart patterns. Another key factor, the difference between price discovery and suppression. Markets are complex ecosystems. Prices reflect supply, demand, liquidity, derivatives, positioning, macroeconomic policy, currency strength, and investor psychology. When prices fall sharply, it's tempting to assume manipulation. Sometimes there have been proven cases of misconduct, documented by courts and regulators, but price movement alone is never proof of wrongdoing. More often, volatility is a function of leverage unwinding, liquidity gaps, or macro shocks. If you're going to operate in commodity markets, separate verified legal findings from speculation, and speculation from data. Data is your anchor. Warehouse reports are data. Mine production reports are data. Corporate earnings are data. Import-export statistics are data. Futures open interest is data. Government policy announcements are data. Everything else is interpretation. The most disciplined investors build theses on measurable trends and constantly update those theses. When new information arrives, if silver inventories begin rising sustainably, that's data. If industrial demand projections are revised downward, that's data. If technology reduces silver intensity, that's data. If central banks or sovereign funds publicly report strategic stockpiling, that's data. Strong investors adjust. Weak investors marry narratives. One of the biggest mistakes in volatile markets is turning an investment thesis into an identity. When that happens, objectivity disappears. You stop evaluating risk. You start defending beliefs. The healthier approach is this. Have a thesis. Define your time horizon. Define your risk tolerance. Define your exit criteria. Reassess periodically. No single email, no single headline guarantees anything. What history does show, however, is that real supply deficits eventually resolve in one of two ways. Either demand contracts or price adjusts high enough to incentivize new supply. That's basic economics. The question isn't whether markets move. The question is when and how. If you're positioning in silver or any commodity, ask yourself, am I investing based on structural fundamentals or short-term momentum? Do I understand how futures markets work? Am I prepared for 30% volatility swings? Is my position size aligned with my financial reality? These are the questions professionals ask every day. And here's something equally important. Capital preservation beats excitement. You don't need to catch every move. You don't need to predict the exact top or bottom. You need to survive long enough for your thesis to play out, if it plays out. Markets reward patience, but only if paired with discipline. As this series continues, the goal isn't to create urgency. It's to create clarity. Clarity about structure. Clarity about risk. Clarity about incentives. Clarity about how global capital behaves. When you understand those layers, you're no longer reacting emotionally to volatility. You're interpreting it. And interpretation is power. We'll continue breaking down the data, the mechanics, and the macro landscape, step by step. No hype, no speculation presented as fact. Just structure and analysis. Stay focused, stay rational, and I'll see you in the next one.